It's not the customer that's scared off by FHA. It's this seller who's usually been told by their realtor that it's a scary thing and that the appraisal's harder. And the appraisal does have a few standards that are different, but if the house is garbage, you can't go conventional either, right? So the house just has to be in livable condition. It can have old carpet. It could look like 1984 in the house, which would probably be cool. There'd be a Farrah Fawcett poster and maybe a David Lee Roth poster, and that'd be kind of cool.
It would.
Right? And it can have orange shag carpet and white cabinets. It can have all of the things that are bad. It just can't have holes in the wall or missing carpet, or a leaking roof.
One of the things that you touched on was PMI.
Mm-hmm.
And, people talk about putting 20% down to buy a house, which would be great, but certainly not everyone can do that because that is a large chunk of money in a lot of cases. So they get scared off by paying PMI, and people have blown this up to be, oh my gosh, you got to pay PMI. And what's PMI? And in my opinion, it's not that big a deal. Yes, it's more money, but in the long run, I don't think it's the worst.
PMI is the greatest thing to happen for home ownership.
Okay.
Because if you think about before PMI, when my probably grandparents bought their first home, they had to put down 20%. It was the only option. It was 20% down.
Yeah.
And everybody wonders where that magic number of 20% down comes from. Well, it comes from foreclosures, right? So the banks figured out that if you buy a house and they do a mortgage for it and you default on that loan, it's going to cost them about 20% to get you out of that house, to go through the process of foreclosure, to evict you, to clean it up, to get it listed, and then to get it sold. They're going to lose 20%. So back in the day, you went to the bank, and if you were going to buy a house, you had 20% down. And I don't remember the year, but one of the presidents wanted to make home ownership more available for people. So
what year?
I don't remember the year.
Ish?
I don't know. I'd be lying if I said.
Okay.
Older than JFK.
Okay.
We'll say
all right.
that.
Got it.
So they got 6 of the largest insurance companies together and said, let's make up some insurance that protects the banks against default. And that's all private mortgage insurance is. It's an insurance policy that protects the bank for that first 20%. So if you put down 3%, your PMI is going to be a higher calculation than if you put down 15%. And the breaks are 3, 5, 10, 15, and then of course at 20 you have no PMI. And PMI, I listen to my parents or people older than me, which there's still some people out there that are older than me.
A few.
They all have this horrible thing about PMI. Oh, got to get rid of that PMI, and there's always this negative. But PMI in 2018 became tax deductible. So now it's just like your interest, right? So you get to write the PMI off. And if you don't have 20% down, PMI is a hell of a lot better than renting, right? So do 5% down. And the PMI, if you look at the dollar amounts that we're talking about, it's like 0.2% or 0.1%. And if you have bad credit and a really high DTI, well, then it may be 0.9%. But still, it's just a small percentage that most people that want to buy a house that don't have 20% down, it gives them a great option. And the only loans that have PMI, private mortgage insurance, are your conventional Fannie Mae and Freddie Mac loans. VA, of course, has no PMI at all. They have no mortgage insurance of any kind. But as a vet, if you don't have a disability through the VA, then you pay an upfront funding fee when you purchase the home. So you either have a 2.15% or $2,100 on a $100,000 purchase. And if it's your second time or subsequent use, you're buying a new house VA, now it's 3.3%. So that dollar amount goes up. It does go away if you have the disability of 10% or more. When you look at FHA, you have a 0.5% PMI or MI. It's not private, it's government. And then you also have an upfront mortgage insurance premium of 1.75% of whatever your loan amount is, financed onto your loan amount, so it doesn't come out of your pocket. And then USDA has a 0.35% mortgage insurance with a 1% guarantee fee. So FHA, VA, and USDA, if you wanted to put 20% down, you still have those fees. Doesn't matter. Those are the things they don't. It keeps it solvent, right? So conventional loans are the only ones that give you that option to not have it.
And in the last few years, FHA and VA have been, I'll say, challenging to get an offer accepted, especially in 2021. I mean, it's pretty much conventional cash or nothing.
Right.
That has shifted,
Sure.
and I know you've talked to me about FHA versus conventional, and said in a lot of cases FHA is really a better option for maybe not most, but a lot of buyers. But they're scared away by it.
Once you hit that 680 credit score, 680 and below, you're better off FHA because the interest rates are lower. The PMI or the MI that's on an FHA loan is fixed at 0.55%. So if your credit score gets lower, the MI doesn't change. If your debt to income ratio gets higher, the PMI doesn't change. Where on a conventional loan, those are all factors: credit score, debt to income ratio, and how much you put down. So when you have maybe a higher debt to income ratio, lower credit score customer, they're going to be better to go FHA. And it's not the customer that's scared off by FHA. It's this seller who's usually been told by their realtor that it's a scary thing and that the appraisal's harder. And the appraisal does have a few standards that are different, but if the house is garbage, you can't go conventional either, right? So the house just has to be in livable condition. It can have old carpet. It could look like 1984 in the house, which would probably be cool. There'd be a Farrah Fawcett poster and maybe a David Lee Roth poster, and that'd be kind of cool.
It would.
Right? And it can have orange shag carpet and white cabinets. It can have all of the things that are bad. It just can't have holes in the wall or missing carpet, or a leaking roof. You can't have a leaking roof conventionally either.
Isn't that going to hurt my credit if they keep pulling my credit at these various places? And
can I just tell them yes?
Yes, just call you one time.
Just call me. Yes, it's going to hurt your credit. No, it doesn't hurt your credit. There's a 14-day allowance to have your credit pulled in each segment of industry that you're having your credit pulled in, whether it be a car people, bank card people, or mortgage people.
So if I go to a car dealer and have them pull my credit, and then I call you to buy a house a couple days later, it's within the 14-day window?
No, it's two different
They're
pulls.
Two separate ones. Okay. Yeah.
So you got to stay within your industry.
I got you.
So, people are like, I don't want to have a hard pull on my credit. It'll ruin my credit. And I've never, ever turned down somebody because they had too many credit pulls. It's really because they don't pay their crap on time.
There's that.
So anywhere from 0 to 5 points.
That's what I was going to ask.
Is what it's going to hit your credit score. So in the mortgage world, here's what you don't want to do. Okay, and I get this a lot. If one guy tells you your credit score is too low, there's no need to call the next mortgage guy.
For sure.
Because your credit's too low, right? But if the guy didn't help you at all, I spend probably more time on the phone with a customer whose credit doesn't work than I do with a customer that's good to go. Because it takes 20 minutes to get a pre-approval done. But it may take me an hour to explain to you what to do to fix your credit. So it's important that when you hang up with the phone call that this is what I got to do to get my scores up and fix my credit. And, when you're talking program, debt to income ratios, they're all the same, right? We're talking about Fannie Mae's guidelines,
math,
Freddie Mac's guidelines, FHA's guidelines, right? So I have to write everything to those loan guidelines, and so do all the other people that do FHA loans. Now, where you maybe get into little differences is where lenders will put their own rules on top of whatever the FHA rule is. For instance, some banks won't do an FHA mortgage below a 600 credit score. But FHA's guideline is 580. FHA's guideline really is 580 for 3.5% down. 10% down or more, you can have a lower credit score than a 580.
Interesting.
You have to get an accept, and there's within the automated underwriting system, and then there's some credit parameters inside of that. So it's really hard to get it done, but it's doable. So if you call 3 or 4 banks, and I get this all the time, well, the other 3 people told me this, and I'm like, yep, your debt to income ratio is a 64, you don't have any money down, you don't have a job yet, and your credit score is a 400. So how do you feel the housing market is going today?
In my world, and it's not the same for others that I see, but my world is really slow right now. Okay. Though I am hearing that from other realtors.
Absolutely.
But I do find like members of my team have been doing great, with getting homes pending and listing homes and things like that. In a normal real estate market, things tend to start to slow down seasonally at this time of year. As closer we get to Halloween, people start to drop out for holiday reasons, travel reasons, weather reasons. Here in Indianapolis, I think weather is a big factor in that.
Yep.
But I feel like this year things almost started a bit earlier.
Mm-hmm.
And interest rates have a ton to do with that.
Absolutely.
I actually have an article here from Redfin that says, and this is a national article, but still, that home buyers have to earn about $115,000 a year to be able to afford a typical house at this time. That's a lot of money.
It is, yeah, it's crazy.
Now, the annual income required in Indiana is almost $82,000. That's a lot of money.
And that's going to vary where you're living in Indiana too, because that's not Carmel.
That's
not Fishers and not Westville.
Absolutely not. Yeah. One of the things it says here is that everywhere in the country, you have to be earning at least $50,000 or more to be able to, at least $50,000 to be able to afford a home at this point.
But you know what's crazy is you almost have to be making that to afford rent today too.
Yeah.
Because rents have gone up super fast as well.
Yep. The median, which mathematically means middle, rent in Indiana is $2,045.
Yeah, that's insane.
Wow.
Yeah, that's insane.
That's incredible. I actually, related but side note, I saw an article about rents in the nation in New York City for a one-bedroom, maybe studio apartment was $4,000 a month.
I've seen that same thing. It was for 433 square feet.
Now, number one, you better be shopping at IKEA because then you can walk in and they will show you at 433 square feet.
Walk into your closet.
Oh my gosh.
That's a hotel room.
That's. I dislike continuing to use the word insane with realty, but that's insane.
Oh, it's crazy.
432 square feet for $4,000 is a whole lot of money. And
you get nothing for it.
Oh, for sure.
You get nothing
that's the huge downside to rent, of course. You have no control over whether or not your landlord raises your rent. Right. Granted, you do have a lease, but when that lease expires, you can almost guarantee your rent's going to be higher if you go to renew it.
Yep.
And you're not earning anything off of that money. It's literally just money going out the door. Now, sometimes rental is the way to go for people because they just don't earn enough, and that's the best they can do. Right. And there's no fault absolutely whatsoever for that. But if you look at $2,045 is the median mortgage payment. If you're making a rental payment that is anywhere near that, you might as well talk to somebody about buying a house because your money is better off going towards a house than it is paying rent and getting nothing back for that.
Sure. And keep in mind, just because you can make that $2,000 payment doesn't necessarily mean you'll qualify for a mortgage based on your debt to income ratio. And I hear that all the time. I hear customers be like, I'm paying, $2,000 a month now, and I can't qualify for a $1,600 mortgage payment. But it's about that debt to income ratio. It's about, buy the car after you buy the house, because cars don't have a debt to income ratio. So there's a lot of people driving new cars, and I don't know if you've seen this number, but the average car payment in the United States is recently went over $900 a month.
Get out of
for
town.
Your average car payment. So when you look at car payments, and then now look at credit cards as well. 2 years ago, your credit card payment may have been, $40 minimum payment. Now it's probably $140 minimum payment. And then, of course, this month, school loans, kick back in. So all those people that should have been paying their school loans during this whole deferral process because they stopped charging interest, and you could have took a huge chunk out of it.
Yeah.
Now, you're going to have your interest kick back in and payments starting to be made again.
It's now harder for
everything keeps
for buyers.
Harder.
Everything
Exactly.
keeps getting more challenging. Isn't that great?
Well, if it was easy,
everybody be doing it.
It'd be better.
Everybody be doing it. Thanks for watching. Appreciate you being here, Brad.
Cheers, my friend.
Cheers to you, my friend.
If you need a mortgage, or you want to buy a house or list a house, or even have a house that you want to rent out and you need someone to help you find a renter,
we can do all of that.
You can.
That sounds great. Check us out next time. Thanks for watching. Cheers.
Cheers.